Okay, so let's begin this lesson. So today we're going to look at how to prepare the financial statements, which is a statement of profit or loss, as well as a statement of financial position. So this is lesson 13, and what I've just stated is what we're going to look at. So basically, the financial statements are built around what we've been covering in the past lessons, from lesson 1 until lesson 13 or lesson 12 rather, or no, let me say lesson 11. All right, so the thing is that there are two types of financial statements. So there's a statement of profit or loss and a statement of financial position, right? There's also the statement of changes in equity. There's a statement of cash flows, which we covered in the previous lesson. Then also there's the statement of changes in equity. We're going to look at it. All right, but basically financial statements are prepared consistent with the business structure or legal structure of an entity. So if you've got a business that's a sole proprietorship, you prepare financial statements consistent with that legal structure. If it's a partnership, you also prepare financial statements consistent with that particular legal structure. So now, in this particular lesson, we're going to look at the sole proprietorship or the sole trader. Then the following, lesson 14, is we're going to look at the partnership. And then lesson 15, that's the one we're going to look at, the company. So I won't spend too much time explaining the items in this. Most of the stuff has already been learned, and I'm sure if you went through the lessons from lesson 1 until lesson 11 or 10, you'll be able to understand everything that's outlined in this format. And the other thing I'm going to request you is you need to memorize this format. Have it at the tablet of your heart, because in the exam you'll be told to prepare a statement of profit or loss and a statement of financial position, and you won't be given the format. You just need to make sure you remember, right? So let's begin. So basically, a sole trader, when you see a name of an individual, John Banda, Mary Piri, I can't believe I've run out of names, but yeah. So when you see an individual's name, then you know it's a sole proprietorship. A person's name, a name, right? Then for a partnership, if there are three names, maybe John, Piri, and Chewe, then that's a partnership. Then for a company, it can be John PLC or John Limited. All right. So these are the few nuggets that you need to understand. But the first thing that you need to do when you're preparing a financial statement, a statement of profit or loss and a statement of financial position, you need to write down the title. These are marks. So for a sole trader, John Banda, then you write statement of profit or loss for the year ended 31st December 2024. But in the exam, the year that's outlined in the trial balance, the trial balance year is what you use, right? Is what you include here, right? So the year that you're given in the trial balance is the year that you put for the year ended, whatever year that is. Then the first thing that you need to do, you need to put the currency marks, kwacha here and kwacha there, right? The second thing that you need to do, you need to put the sales. So sales are always the first item. Sales are always the first. So this format I'm giving you is it's a consistent format that you need to be using all the time. And that's the format you're going to be using even as you progress to financial reporting and advanced financial reporting. So we've got sales here. Then the second thing is sales returns and return inwards, right? You know what these sales returns are. You make a sale, but the customer brings back the goods for one reason or the other, right? That's a sales return. So you deduct it from the sales. Then when you do that, you're going to have what's called the turnover. So the turnover, you bring it here. So once you're done with that particular part of this format, you need to go to the cost of sales. So the cost of sales comprise of opening inventory. So you have the opening inventory and you put it there. You have the opening inventory and you put it there, right? Opening inventory, this is the inventory, the stock that's in the trial balance. So there'll be a stock that will be in the trial balance. Sometimes it can be in the trial balance, but it will be in the notes. But one thing that you need to know is the stock at the beginning of the year. So if the year begins at 1st January 2024, that inventory that's relating to 1st January 2024, that's the opening inventory, and that's what you bring here. Then purchases you'll be given in the trial balance. You just get this figure. It's on the debit side of the trial balance. You need to put it here. Purchases returns or return inwards. You know what this is? You buy something from the supplier, but due to one reason or the other, you take it back, right? And purchases returns, you deduct. You put them in brackets, right? Purchases returns, they are the opposite of purchases. Purchases are always on the debit side, right? Then purchases returns are on the credit side. So you need to make sure you know these things. Then carriage inwards. You know what carriage inwards is? You know, you buy goods, then you transport them to the company premises, right? Those are the return inwards. Then closing inventory. What's closing inventory? You know what closing inventory? This is inventory at the end of the period. Inventory at the end of the period. If the year ends at 31st December, the inventory at 31st December, that's the one you include here. Usually the closing inventory is in the notes. So the inventory in the notes is what you include here. So once you do all this, you find the net. This is what you're going to deduct from the turnover. All right. That sometimes, it's not always, but sometimes this is where a trader, gets some goods for personal use. So when a trader gets some use for goods for personal use, those goods are supposed to be deducted from the opening inventory and the purchases. So inventory plus purchases, and then you make a deduction, right? You say drawings here, and then you put it in brackets, just like the return outwards. And then when you find the net here, then you're going to have what's called the gross profit. So turnover minus cost of sales gives us the gross profit. So now there's sometimes where you are dealing with the supplier, and the supplier you buy in bulk, and that supplier gives you a discount, and that's what's called discount received. And that discount received is a positive, it's a plus, it's treated as an income. So you say discount received plus gross profit, and you're going to get this total here. So how these items are outlined here, just make sure you memorize them the way they are, and it's going to be easy for you. Then you've got expenses. So after you carry out these transactions, these entries, right, you need to list the expenses. And the other thing, let me say this, in the exam, actually what the examiner marks are the entries. So if you memorize these entries, just know that there are some marks that are already waiting for you. So now, expenses, you list the expenses. The first expense that you need to be thinking of, depreciation. Depreciation, remember, depreciation is twofold. There's depreciation for reducing balance, there's also depreciation for straight line method. But you have to remember the notes and apply them, right, in this particular context. Given if mostly for motor vehicles, it's reducing balance. Then for buildings, it's usually straight line method. But I'm not saying it's a given, but you'll be told, saying, okay, this is the type of depreciation that they use. And when you calculate that depreciation, you bring it here. And that same depreciation, you have to deduct it from the cost or of that particular asset. Right? Yes. So now the next thing is utility bills. So I just put utility bills just to aggregate them, but you need to write them independently. So if it's electricity bills or water bills, write them independently. So electricity bills you write, water bills you write down, right? So then if it's interest, so now let me explain this concept of accrues and prepayments. So remember that there's a topic that we learned about accrues and the prepayments. So the best example for explaining accrues is interest. So interest, let's say we've got a loan of 100,000. then we're paying interest of 10%. So 10% of 100,000, right? 10% of 100,000 is going to give us 10,000, right? So this is the amount of interest that we need to be paying on an annual basis, per annum, right? So now, in the trial balance, you've been told that 5,000 of interest is what has been paid. 5,000 has been paid. But you know, at the end of the year, the amount of interest that's supposed to be paid is 10,000. So now, you need to add that 5,000. 5,000. So plus 5,000, right? Then you're going to get the 10,000 that we're looking for. So this is 10,000. This is what you put in as the expense. So it's supposed to be 10,000, even though only 5,000 was paid. So this extra 5,000 is what's called an accrue, right? It's an accrue. So now, this same amount is supposed to be included in the statement of financial position as a current liability, right? So if you've got an expense that's supposed to be paid in full, but only half has been paid, you have to add the remaining half, or the remaining quarter, or the remaining amount, aggregate it, and the total is what you include as expenses, right? That's what accrues are. So now, usually interest, you're going to be finding that problem when you're dealing with interest. That's a problem that you are more often than not going to find yourself handling. So now, that's for interest. So you get that interest, you put it here. Then there's also the other thing that you need to have off the top of your head, right, is prepayment. So let me use insurance to explain prepayments. So prepayments and accrues, they can work for all expenses, right? All expenses. Interest, insurance, electricity bills, water bills, rent. So now let me just use interest or insurance to explain this. So now let's say we've paid quarterly insurance. We've paid 3 months. So we paid in November up to January, right? Up to January. And we paid 1,000, just for simply 1,000. And we've only, the year ends on 31st December. So we've only used 2 months, November and what? December. So there's 1 month which we haven't yet utilized. So that 1 month, we have to find the amount that's apportioned to 1 month in that 3 months out of the 1,000. And this 1 divided by 3 is 333, so it's going to be 333. So now, out of this 1,000, we've only used 2 months and 1 month we haven't used it. So 333,000, right? We need to deduct it from 1,000. And the remaining, right, which is something like 667, if I'm not mistaken, right? Right? That amount, you need to deduct it, or rather, that amount, you need to include it as a current liability, or rather, a current asset, sorry. So we put 667 here, alright? That's the amount of expense that you need to recognize. This 333, you need to include it as a current asset. And this is how you treat accrues and prepayment. So this is, sorry, this is how you treat prepayments. I don't even know why I said accrues, but that's how you treat prepayments. Okay. So again, so rent, you can either have a prepayment or an accrue, but how I've explained is how you're supposed to treat them. Allowance for doubtful debts, you know what this is. So any allowance, usually the allowance that's in the trial balance, sometimes you can be also given an allowance for doubtful debts in the notes, right, in the adjustments. So those adjustments, the allowance for doubtful debts in the adjustments plus the allowance for doubtful debts in the trial balance, you aggregate them and then you deduct that amount from the what? From the receivables, right? Even irrecoverable debts, these are debts that won't be paid back. What do? You also have to pay them back. You also include them here. right? These are debts that won't be paid back. Then increase in provisions. You know what increase in provisions is? Increase in provision is an expense. Expenses have increased, they've heightened, they've gone up. All right. These these allowances for doubtful debts. You think these debts are going to go bad. These the debtor won't be able to pay back. You make a provision, but that provision increases, right? What do? You need to include it as an expense. But if that provision reduces, what do? You need to include it as an expense, but it's supposed to be deducted from the expenses. Then the other trick is this increase in provision and decrease in provision, right? You need to make sure you understand how the question is being phrased. Sometimes they might say the provisions increased to, or provisions reduced to. So you need to find the difference, right? Then sometimes to be provisions increased by, right? Provisions reduced by, right? Then there's that specific reduction. You get that if it's by, you get that specific reduction that you've been given. But if it's to, you need to find the difference, right? So now that amount which the provisions have increased to or have decreased to is the amount that you need to deduct from the receivables value. So you need to deduct both the irrecoverable debts, right? Largely the amount in the if I've said these amounts were not included, right? The adjustments were not carried out, right? If you're told that the amount in the trial balance has not been deducted from the receivables, then that's when you need to deduct it from the receivables. But if you have been told that this particular transaction was recorded, you don't have to deduct. But mostly what's in the adjustments, these are transactions which have not been recorded. So largely what's in the transaction, what's in the adjustments for relating to the allowances and doubtful debts, as well as the increases and decreases. What's in the adjustments, right, is what you adjust in the receivables value in the statement of financial position. So for instance, let me give an example. So if there was at the end of the year there was 1,000 debts that were going to be recoverable, and then there was also the provisions increased to say 500, right? If these items are in the adjustments and you've been told these items were not included in the books of the company, right? So you've got a total of 1,000 here, which you need to deduct from, let's say, 10,000, right? Total receivables, you need to deduct that. Then you've got, right, then you've got 850 here, right? And this 850 is what you need to recognize as the receivables, right? Yes, right? So now when you go through questions, it's going to make much more sense. That's when you're going to wrap your head around what I'm explaining here. So now, after you've done that, you found the total. The total expenses. So these total expenses are supposed to be deducted from the total of the gross profit as well as the discount received, and then you are going to find the net profit. With that done, then the statement of profit or loss has ended. So please make sure you memorize each and every step, like what you are marked at the entries. So if you know where the sales are, you know where the returns sales returns are, you know where the turnover is, you know the purchases, you know the carriage inwards, you know the closing inventory, you know the discount received, you know depreciation, utility bills, where everything is supposed to be. If you know, that's exactly what you're marked. All right. So for now, our lesson ends here. So part 2 of this lesson we're going to look at the statement of financial position.